Hello and welcome to our YouTube channel, The Loophole, the hidden cost of legal finance every day. Millions of people sign contracts they believe will help them build a better life. But what happens when the fine print becomes a trap and the system designed to protect you is the one profiting from your struggle? This is the story of how legal finance became America's silent crisis across the United States. A massive industry operates in plain sight. It's called consumer finance, and it includes payday loans, car title loans, subprime credit cards, and rent-to-own schemes. These products are perfectly legal. They're regulated. They're advertised during daytime television, but for millions of Americans. These financial tools have become a cycle they can't escape. The industry generates over $40 billion annually, and it does so primarily from people living paycheck to paycheck. Federal Reserve Consumer Credit Report 2023. This isn't a story about crime. It's about what happens when profit motives and poverty collide within the law. The roots of modern predatory lending stretch back to the 1980s and 1990s. During this period, banking deregulation swept across America. Laws that once capped interest rates were weakened or eliminated in many states' National Consumer Law Center historical analysis. Financial companies saw an opportunity by the early 2000s. Payday loan stores began appearing in low-income neighborhoods across the country. These businesses offered small, short-term loans with a simple pitch. Get cash now, pay it back on your next payday. The catch was the interest rate, often exceeding 300% annually when calculated as an APR Consumer Financial Protection Bureau 2017 study. The 2008 financial crisis made things worse. As traditional banks tightened lending standards, millions of Americans lost access to conventional credit. Alternative lenders filled the gap. By 2010, there were more payday loan stores in America than McDonald's and Starbucks combined. Center for Responsible Lending report. The industry evolved rapidly. Online lenders emerged, making it even easier to access high-cost loans. Rent-to-own stores expanded their reach. Car title lenders grew in states where payday lending faced restrictions. Each variation operated within state laws, but the underlying business model remained the same. Profit from repeat borrowing. Multiple government studies have documented the patterns. According to the Consumer Financial Protection Bureau, over 80% of payday loans are rolled over or renewed within 14 days. CFPB 2014 data report. This means most borrowers cannot afford to repay the loan and the fee at once. Instead, they pay another fee to extend the loan, entering what researchers call the debt trap. The Pew Charitable Trusts found that the average payday loan borrower takes out 8 loans per year and spends roughly 200 days in debt. Pew Research 2012 payday lending study. The fees add up quickly. A typical 2-week loan of $300 costs $45 in fees. If renewed every 2 weeks for 5 months, the borrower pays $540 in fees on that original $300 loan. State regulators have documented similar patterns with car title loans. These loans use a borrower's vehicle as collateral. If the borrower defaults, the lender repossesses the car, often leaving the borrower unable to get to work. Federal Trade Commission Consumer Alert. Studies indicate that roughly 1 in 5 car title loans ends in repossession. Consumer Federation of America analysis. The industry defends its practices by pointing to demand. Lenders argue they provide a necessary service to people who cannot access traditional banking. They note that their costs include high default rates and operating expenses in underserved areas. Community Financial Services Association position. Statements. Some economists argue that restricting access to these loans could leave vulnerable people with no options at all. Research from the Federal Reserve Bank of New York suggested that when states banned payday lending, some residents faced increased difficulty paying bills and experienced more bank overdrafts. NY Fed Working Paper 2011. Consumer advocates counter that these studies often fail to account for long-term harm. They point to research showing communities with more payday lenders have higher rates of bankruptcy. Vanderbilt Law Review Study, 2016. The causal relationship remains debated in academic circles. There's also disagreement about solutions. Some states have implemented strict interest rate caps. Others focus on requiring lenders to verify borrowers' ability to repay. A few states have banned certain products entirely. Each approach has produced different outcomes, and researchers continue to study which interventions work best. Behind the statistics are real people facing impossible choices. A single mother in Ohio borrowed $300 to fix her car so she could get to work. 6 months later, it paid over $800 in fees and still owed the original $300 testimony to Ohio State Legislature. The loan meant she could keep her job. But the debt meant she couldn't afford groceries. A veteran in Missouri took out a title loan to cover medical bills. When he couldn't make a payment, the lender repossessed his truck. Without transportation, he lost his job. The spiral continued. Missouri Department of Commerce consumer complaint records. These aren't isolated cases. Millions of Americans use these products each year. Many are employed, working full-time jobs that simply don't pay enough to cover emergencies. Others are elderly people on fixed incomes or families hit by unexpected medical expenses. The common thread is financial fragility. One setback becomes a crisis, and the crisis becomes chronic debt. Financial experts describe this as a poverty tax. People with money can access cheap credit. People without money pay exponentially more for the same amount of cash. The difference isn't risk alone. It's a business model built on repeat transactions. Think of it like this. A bank wants you to repay your loan and never need another one. A payday lender's profit model depends on you needing another loan. One study found that if borrowers only took out one loan per year, 76% of payday lenders would go out of business. Fordham University Law Review analysis. The industry needs the debt cycle to survive. This connects to broader questions about inequality. When people pay 300% interest, they have less money for housing, education, and healthcare. Communities with concentrated predatory lending see wealth drain away. Children grow up watching their parents struggle with debt. The cycle perpetuates across generations. Here's what we know for certain. Legal lending products with extreme costs trap millions of Americans in long-term debt. We know the industry is profitable, regulated, and defended by some as providing necessary services. We know the human cost is measurable in lost cars, homes, and opportunities. What remains uncertain is how to balance access to emergency credit with protection from predatory practices. And now, the debate has entered a new phase. Several scenarios are unfolding simultaneously. At the federal level, the Consumer Financial Protection Bureau has proposed new rules requiring lenders to verify ability to repay before issuing loans. CFPB Proposed Rule 2023. Implementation, likelihood, medium. These rules face political and legal challenges. More states are considering interest rate caps. Following the model of places like Colorado, which capped payday loan rates at 36% APR, Colorado Attorney General report on lending reform. Likelihood of widespread adoption, medium. The industry typically challenges these laws in court. Technology is also changing the landscape. Financial technology companies are offering alternatives like earned wage access and small dollar loans with lower rates. Whether these genuinely serve consumers better or simply represent new variations on old models remains to be seen. Confidence level. Low. The sector is too new for comprehensive research. One thing appears certain. As long as millions of Americans live on the edge of financial disaster, someone will profit from that desperation. The question is whether we decide those profits should have limits. The hidden cost of legal finance isn't just measured in dollars. It's measured in lost opportunities, broken families, and communities trapped in cycles of debt. The system is working exactly as designed. The question is, designed for whom? If you want to understand how financial systems shape inequality at an even deeper level, watch our next video, Why Your Bank Account Costs More When You're Poor. It connects directly to the patterns we've explored here. Asterisk, asterisk. Source notes and disclaimer. Asterisk, asterisk. This script draws from government reports, academic studies, and documented consumer testimonies as cited throughout. The lending industry and regulatory environment continue to evolve. Information current as of late 2024. No financial advice is provided. Viewers are encouraged to research their own situations and consult qualified professionals for personal financial decisions.